Well, after 2 big years of double-digit percentage gains on North American stock markets, particularly those markets in the United States, stocks are off to gains in the early portion of 2025 as well. Our next guest expects more moderate returns this year, however, and higher volatility. For more on how he's preparing his client portfolios, Greg Taylor joins us now. He's Chief Investment Officer at Purpose Investments. Greg, thanks a lot for coming in.
Thanks, Paul.
What is your take on what is reasonable to expect this year in markets? Markets are off to a fast start. The S&P 500 in the U.S. up 2/3 of a percentage point in just a few trading days.
Oh, it seems we enter every year and kind of predict volatility is going to come this year, and it feels like this might be the year. We've had the VIX in the 15 to 20 range for most of the first few trading days, and just feels like, if you remember back to President Trump's first term, that volatility is the name of the game, and I'd expect it to be a volatile year. And when you're coming into it after 2 years where we've had plus 20% returns, I think the setup's a little more dicey, and as much as we'd like to go for the three-peat like the Kansas City Chiefs, it's going to be tough to get another 20% returns unless we get some big earnings growth. Entering the year, we've already got multiples extended and near the top of the range. So if we are going to get one of those big years in the markets, it's either going to see the market really broaden out or big earnings growth is going to be the name of the game.
What kind of volatility do you expect? Do you expect markets to potentially to decline this year, or just for it to be a choppy year with a smaller gain?
Well, I think in that scenario, the best case would be more of a choppy scenario with just consolidating these gains we've had in the last few years. And I think really more than anything, it's going to come back to the fixed income market. The bond market is going to drive the volatility this year. The currency market's going to have a big impact. And I think equities are going to be more collateral damage on the side at the end of the day. We've already seen some big changes to expectations for rate cuts from the Fed. A few weeks ago, we were looking for 4 rate cuts. I think we're now down to 1 rate cut for this year. So looking at how the Fed's going to manage this volatility, and certainly we've got the headline risk coming out of Washington and threat of tariffs, threat of trade wars. All this stuff is going to be headline risk, which I think is going to leave investors more on the back foot and not willing to take as much risk as they've had in the last year.
So with that in the background, what do you think are the right strategies for 2025?
Well, you can almost barbell it this year, because I don't think the AI theme is really going to go away. We've still got a tremendous growth from data centers, from AI, from the semiconductors. So you kind of want to have some of these big mega cap tech stocks, because they are still going to be tremendously great companies. They're not huge valuations, especially when you compare it to the dot-com bubble, and they're growing faster than the market. But at the other end of the spectrum, I think you want to look at more some of the value, some of the financials. I think the financials have been beat up for the last year. They're starting to turn the corner and act a lot better. And I think you can also see a bit more as this market broadens out some of the commodities. I do think there's one thing the market might be getting wrong right now, and that's the strength in the U.S. dollar. I think President Trump really does want to see the dollar go lower over time, and if the dollar goes lower, that's a great setup for commodities. So it could be a year that Canada does a little better, but we got to get through some of these near-term issues first.
What is your view on crude oil?
Well, I think oil is going to be a tough one. It should be a gauge of just general global growth. But we've seen all these Mideast tensions, and nothing's really impacted the price. So I think at the end of the day, crude's going to bounce around between 65, 75 for most of the year. And at the end of the day, that's not a bad outcome for these companies, because they have spent the last 5, 10 years right-sizing their balance sheets, becoming more efficient. And I think really the companies are going to be more skewed to natural gas are going to do a lot better. So I think crude's going to be more just range-bound and not going to be seeing any big gains this year.
Okay, but the setup for Canadian oil and gas producers is constructive, you think, particularly for the gas producers?
Particularly for the gas ones. We've got LNG capacity coming on. We've got a lot of the companies that really haven't done that much in a price terms in the last few years. Tourmaline, it feels like, has been sideways for the last 2 years, but they keep building reserves, building production, and it's still a tremendously well-run company. So natural gas is something I prefer over oil, and I think you're set up for a decent move this year, and the valuations are certainly looking pretty attractive.
Okay, gold was a big story in 2024, although the price is more or less flatlined since the fall of 2024. It's sort of hovered around that $2,600, $2,700 level. There are lots of predictions out there for a breakout to 3,000. Are you in that camp?
Well, I think you have to be impressed with just how gold has acted in the last year, because normally gold and the dollar act in opposites, that when the dollar goes straight up, gold goes down.
Right.
And we've had a period where the dollar has gone, US dollar has basically gone straight up, and gold has had one of its best years ever. So it's kind of an impressive move. And I think that just shows that there's a lot of people that are starting to diversify, looking for real assets, looking for something that's not as correlated to the markets, and also offer some protection from geopolitical risk. So gold fits a lot of those bills. And if we do get a scenario where the US dollar does start to pull back, I think that could be a great setup. And certainly 3,000 seems a long way away, but that's certainly something that can be in the cards, because when gold bull markets take off, they can get pretty impressive.
Final question. Do you like the setup for TSX traded gold mining companies?
Well, they certainly have lagged the commodity, and I think that's the impressive thing, that the miners have dramatically lagged the commodity. There's a lot of people that look at that ratio, and when you've got the miners lagging to this degree, there's a lot of people that are saying we should switch from the commodity to the miners. Certainly the miners do struggle with inflation, and costs have been going up across the board, but when you look at Canadian miners or people that have mines in Canada, this is looking like a good beneficiary, because the Canadian dollar, as we all know, has been under pressure. So that goes to the bottom line. So I would skew towards Canadian miners and think the setup's pretty attractive here.
Greg, thanks.